Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. Tech shares once again leading the declines. Apple, Facebook, and Microsoft pulling the broader markets down. This on the back of Fed Chair Jay Powell saying he's not sure how quickly the economy will recover, and tensions continuing to rise between the United States and China. Now, the Trump administration is calling on gaming companies to provide information about their data security protocols with the Chinese tech behemoth Tencent. Meantime, TikTok's Chinese owner ByteDance and Oracle have agreed tentatively to the terms of a potential deal, but it has to be approved by the U.S. and Chinese governments, and significant confusion about timelines and deadlines remains. Let's dig into how the markets ended the day first with our senior markets correspondent, Scarlett Fu. Scarlett, obviously, tech leading the declines, but outperforming all year. What's been happening the last couple of days?
There's been a lot going on, Emily, and to some extent you can blame it on the Federal Reserve. As you mentioned, Jay Powell making clear that rates will stay at current levels for lower for longer, but investors were positioned for a dovish surprise and they were kind of left hanging. So when you look at what happened in equities, I include the S&P 500 equal weight index to show that most of the damage is from the large cap. The big tech names. But it was a broad decline overall, 8 out of 11 sectors and 20 out of 24 sectors finishing lower. Today's outperformers were the value and the cyclical stocks. And if you look at what's been going on over the past 2 weeks, that's been a pretty clear theme. The two best performing groups, materials and industrials, and the worst performers, tech and communication services. And when we say tech, it's really pretty much Apple, Microsoft, and for communication services, Facebook and Alphabet.
So what does that mean for the growth trade, which was really led by tech?
Yeah, it's a good question. No one's ready to say that the growth trade is over. We've done that a couple of times and it hasn't paid off. Growth has trounced value for so much by so long, for so long by so much. I mean, both scale and in terms of duration, that we're not accustomed to thinking of any rotation as really being sustainable. Since the pandemic began, by my count, there's been at least 8 instances in which value has outperformed growth. And if you look at the bottom panel of that chart, it's the red sections where you see value doing better, but they all turned out to be head fakes. So the question really that everyone's asking is if this tech pullback is a simple correction or perhaps something bigger. And if you look again at the equal weighted index for the S&P, it's still down 4% year to date. And Jack Ablin of Crescent Capital points out that that suggests the downside risk to the overall market is fairly limited.
All right, Scarlett Fu, thank you so much, Scarlett, for breaking that all down for us. I do want to get to the TikTok saga next, and also the latest news that President Trump is now scrutinizing Tencent as well. I want to bring in Anna Ashton, Senior Director of Government Affairs at the U.S.-China Business Council. And Anna, I mentioned there has been significant confusion. There still is significant confusion about what happens next with TikTok. We know that ByteDance and we know that Oracle have tentatively agreed to a deal, but the president still has to sign off on that. We don't know exactly when he has to sign off on that. What is your general belief about how this will play out?
It's really hard to say, Emily. I mean, I think, overall, the executive orders that have been issued related to TikTok and WeChat have created huge uncertainty for the business community. And that uncertainty really isn't going away. But there is a sense that there are going to be more executive orders coming because the underlying issue here with TikTok and with WeChat, and really with any Chinese company that might be in a position to collect data on U.S. citizens, is that there's a national security law in China that allows the government to command any Chinese company to turn over that data. And barring some massive change in the law, I think that concern is going to drive more action from the administration.
So what do you make of this latest news about TikTok, that the government's now calling on gaming companies, the U.S. government, calling on gaming companies to shed more light on their data relationship with Tencent, which is a huge company that has tentacles around the world, and certainly broader implications on, just Chinese companies trying to do business in the United States?
Yeah, definitely broader implications. So Tencent is the parent company of WeChat, and the WeChat executive order issued on August 6th was issued, at the same time as the first TikTok order. And, again, this comes down to concerns among U.S. policymakers, especially in the administration, but not just in the administration, about, the possibility that any of these companies could be collecting U.S. citizens' data and then turning it over to the Chinese government, and what might the Chinese government want to do with that data. So not surprising, I guess, that a follow-on from the WeChat order would be to look at other data relationships that Tencent might have with its business partners here in the United States.
So what companies are we talking about here? I mean, if you're a Chinese company and you're wondering if your relationship with U.S. companies is going to be further investigated, who's on that list?
Honestly, I think that what we're talking about here is almost, there's sort of no limit to what you might imagine falling within the scope of this, because it has been rolled out with such broad language and such broadly expressed concerns. Really, we're living in a highly tech-driven era that's only becoming more so. The Internet of Things means that almost every industry has some sort of big data operation going on with its service to customers. And that means that, any Chinese company trying to do business in the United States could potentially, be subject to these same concerns. But of course, right now, what we're seeing is companies that are specifically, owners of applications that their entire business model is in collecting data, and then how they use that data to provide better services to their customers and to better target advertisements and things like that. So for now, we're seeing a focus on tech companies, but it certainly could go beyond that. We've seen this concern arise in previous years when Ant Financial got denied its desire to acquire, I can't remember which company, but an American company, I think an insurance company. They got denied for exactly this reason. CFIUS was concerned with their ability to collect data on U.S. citizens.
So let's talk a little bit about the TikTok mechanics. Obviously, many outstanding questions. What are the outstanding questions in your mind? This in the midst of several Republican lawmakers saying they're not going to approve a deal if it doesn't meet their specifications.
Yeah, I think, there are a few concerns. So I guess to start with, there are two TikTok executive orders. One was issued on August 6th. One was issued on August 14th. The August 6th executive order gave a 45-day deadline, so essentially next Monday, for TikTok to be sold to a U.S. company. The August 14th executive order gave a 90-day deadline and also mentioned that the Committee on Foreign Investment in the United States would have to approve any transaction. We don't know which deadline is in effect here, whether this Oracle proposal has to be approved and enforced by Monday, or if they actually have time to hammer out the details from now until, just past the election in November. We also don't know, there are details we don't know about the Oracle TikTok plan. We don't know if this is a plan to acquire TikTok outright or TikTok's U.S. assets and all of the data that TikTok has collected, and whatever algorithm TikTok uses to collect that data, or whether it's something less than that. If it's something less than that, we have heard from congressmen like Senator Marco Rubio, Senator John Cornyn, and others that that's not sufficient in their minds, that doesn't allay the national security concern involved in data collection and then data transfer to the Chinese government. If it's something more than just a partnership, though, we could see a situation where the Chinese government says, hey, we don't want to see our Chinese company sell the rights or the information, the proprietary information behind this data collection algorithm or this AI that it's using, because the Chinese government has also asserted its rights to approve or disapprove of any sort of transaction that touches on sensitive technology like that. So there's a lot that's up in the air, in terms of whether or not the deal will be approved, and also when the deal has to be approved.
All right. By the way, that company that Ant Financial tried to buy was MoneyGram, but the U.S.
Yes,
starkly opposed that deal despite fierce lobbying by Jack Ma, and that one didn't happen. All right, Anna Ashton with the U.S.-China Business Council, thanks so much for joining us to share your thoughts. Obviously, still many outstanding questions we are waiting for answers for. All right, coming up, riding a strong wave of tech IPOs this week is Sumo Logic, following Snowflake's splashy debut yesterday. We're going to talk to Sumo Logic's CEO next. This is Bloomberg. Cloud-based software maker Sumo Logic today joined this week's IPO frenzy, raising a total of $326 million in initial trading on the NASDAQ. Shares jumping as high as 25%. The listing coming hot on the heels of Snowflake and JFrog's debuts. We spoke to the CEOs of both of those companies yesterday, and joining us now, Sumo Logic CEO and President Ramin Sayar. Ramin, thank you so much for joining us. So you saw some uplift, not double like Snowflake or 50% like JFrog, but they left a lot of money on the table. What is your reaction to the debut today?
Well, first of all, it's an absolute joy and something that not too many companies get the chance to do, and that was something that we've been preparing for quite some time. So it's a very emotional day for all of us at Sumo, and it's a very day where we're filled with joy and gratefulness. As it pertains to the market, if you're really playing the long game and you want to innovate to build a durable, sustainable, long-term company, it's not about the first day or the first few days of trading. It's about that continuous, quarter after quarter of delivery, so that you can not only deliver on the shareholder value, but continue to go after, in our case, the large $50 billion TAM that we're going to try to tackle.
Now, for a company that's been playing the long game, in the last short 6 months, you've been thrown a huge curveball, and I'm curious how you decided to go public now. Did the pandemic accelerate your IPO, or did it give you pause to when as you were trying to decide, like, should we go public in this environment?
Yeah, well, you can't just suddenly plan in a few weeks to go public. This is something that you have to prepare for, game day, so to speak, for quite some time. And this was somewhat we were planning for this year. Timing, we were still trying to figure that out. However, what we have determined with COVID is a tale of two tales. One, that we first had to stop and pause and make sure that we focused on what matters, and that is our employees and our customers. And so that took priority in the near term. Once we were able to get our hands on that, make sure safety, productivity of our employees, as well as helping our customers who needed us most during this time with reliable and secure cloud-native software that we deliver, we felt comfortable to resume our thinking about entering the public markets. And therefore, we decided to focus on this time frame. And we're grateful and appreciative to have been able to do that.
Now, Sumo Logic powers real-time analytics. You work with companies like Slack, you work with AWS, you work with Okta, all names of companies and organizations that have been soaring in the midst of these work-from-home trends. How has the pandemic and the shift to remote work impacted your business?
Well, I think it's been interesting because if you look internally within Sumo, back to having to prioritize the safe and healthy of our own employees, it's not too dissimilar to what we had to do to help our customers with the safety of their employees. And what I mean by that is security, analytics, and intelligence. As more employees now have to work from home, the threat posture and vector, as we call it in the security space, becomes ever increasingly more complex and risky. And so having to rely on legacy tools that were architected for yesterday's problem became a huge challenge for customers. So to your question, we saw an acceleration of a lot of enterprises, not just because of movement to the cloud or digital, because the necessity for security when employees are at home and the data is also distributed.
So how then do you expect the pandemic, as it continues, the uncertainty facing the economy, the lack of clarity about the next year, perhaps even 2 years, how could that impact your business going forward? What challenges do you see on the road ahead?
Well, you can control what you can control. No one predicted COVID, and during good times and bad times, we have a philosophy here that centers around our culture, and that is being it with our customers. So as long as we continue to innovate, as long as we continue to deliver value in our service, we can ride these times up and down and continue to be there as a partner, not just a vendor for our customers. And that's what gave us the confidence during this time. In fact, as we saw in the first part of COVID, even though things slowed down with respect to now the distributed workforce, we saw an increase in the volume of data being analyzed and managed by our platform by our customers. So that flexibility that we provide our customers because of an unknown change due to epidemic is a great testament to what we built for the new, the cloud era, the digital era that we're going after, which is, again, $50 billion market opportunity. So we're happy to be in this position. Now,
So
at the same time,
talking about the cloud era, Ramin, what are the growth opportunities that you see over the next decade?
well, everyone's been talking about cloud and digital transformation. What's important there for any company to digitally transform, they have to build modern applications. And in doing so, as you build modern applications, it creates what we refer to as a tsunami of data, because these new applications are architected differently. These new applications are born and more importantly, even migrated to the cloud. And these new applications need a different security architecture to support that. So effectively, what we're able to help them do is better build, manage, and secure these modern apps to ultimately deliver delightful digital experiences to their end users.
Have you seen much pull forward demand, and could that mean less demand in the quarters ahead?
I don't think, besides obviously some of the impacted industries with respect to travel and hospitality, we can say that generally we've seen different trends by industry and geography. So I don't think necessarily it's pulled forward demand that's causing a slow in the future. If anything, it's a pull forward demand that's accelerating that transformation and that $50 billion TAM that I referred to, which is primed by the $2 trillion of technology spend that's locked in the data center. So I think if anything, it's going to accelerate the digital laggards to those who are digital leaders.
All right. Ramin Sayar, President and CEO of Sumo Logic. Big day for you. Ramin, thanks for taking the time to join us. Okay, coming up, Uber is looking to sell part of its stake in the Chinese ride-hailer Didi. We're going to talk about that move next. This is Bloomberg. Uber is looking to sell part of its $6.3 billion stake in the Chinese ride-hailing service Didi. According to sources familiar with the matter, Uber is trying to offload some of its minority stakes to raise more cash and boost its own share price. Uber is now trading well below the price at which it went public in May 2019. To discuss, we're joined by Rohit Kulkarni of MKM Partners, who currently has a buy rating on the stock. Rohit, what's your take on this?
I think Uber is just being opportunistic in this pandemic. I think they are becoming smart capital allocators as well as freeing up resources and focusing on geographies and segments that they think that they can win. They are either number one or number two in ride sharing or delivery in specific geographies, and also freeing up capital. I think if they are contemplating this deal with Didi, they are just freeing up resources. I don't think they need cash. They have enough cash and liquidity right now. But what they could do is, if they get cash in return for this stake in Didi, they could be more aggressive. They have acquired Careem. They have acquired Corner Shop, Postmates. They have been aggressive recently. So I think I would view this as a sign of more aggressive deal making coming through the pike.
Now, Uber's ride-hailing business has suffered dramatically, though Uber Eats has grown. How is Didi doing in China, given the pandemic and obviously just general environmental turmoil?
Didi has in fact fared a little bit better, as in terms of the recovery and the slope of the recovery that Didi has had. they are probably a couple months ahead in terms of recovery in China, and the slope has been a little bit steeper. Particularly in the markets where Uber is operating, the slope of the recovery and reopening hasn't been as smooth. So Didi's recovery has been better as compared to Uber or Lyft here in the US, particularly with ride sharing. And probably there may be some way that Uber can strike a slightly better deal here, given the way Didi's recovery has been.
So how would you like to see Uber use this cash if indeed they are able to offload this stake?
I feel there are two segments that they are essentially focused on, as in stating the obvious, ride sharing and delivery. There are geographies that they could perhaps go deeper in. Latin America is one place where there is opportunity for Uber to be a number one or number two player. I feel they are still going extremely aggressively against Didi there. So perhaps there is a way to consolidate the market there and be a clear number one player in Latin America. So that's one geography I feel Uber needs to determine what the future should look like, and perhaps with extra capital, they could be more aggressive there.
And what is your outlook on the ride-hailing business in general, given that it looks like we're, only going to have more uncertainty ahead? The arrival of a vaccine keeps getting pushed out farther and farther. It could be quite some time before many people feel safe getting in an Uber again.
I agree. As in, I feel, if you had asked me this question 3 months ago, today, the shape of the recovery, I would have expected it to be slightly better. When you heard both Uber and Lyft talk about their July and August trends, things were slightly softer than what Street is modeling right now. Both are still down 50% year on year. We would have expected slightly better trends. And going forward, I think Uber has a slight hedge here. They have Eats, and so we like Uber as a stock. But as far as structurally speaking, I like Uber more than Lyft, simply given its diversified business, their ability to kind of raise capital through these minority investments, and their scale in most of the geographies. How ride-sharing looks next year, I feel at some point there is going to be a little bit of extra consolidation.
We'll have to leave it there. Rohit Kulkarni on Uber. We're going to talk about the next IPO that happened today, coming up. The COVID-19 pandemic has ushered in a new era for telemedicine. Welcome back to Bloomberg Technology. I'm Emily Chang. Amwell, which powers the back-end virtual services that enable doctors to see patients remotely, also went public today. Shares of the company surging in their debut on the New York Stock Exchange. We are joined now by President and CEO of Amwell, Roy Schoenberg. Roy, thank you so much for joining us. So obviously the future of telemedicine never looked stronger. I wonder, did the pandemic accelerate your go public plans?
It didn't. Thank you for having me, Emily. It didn't accelerate the going public plans. It definitely made it easier for us as we went public to explain to people what the role of telehealth is. I think at this point, a year ago, if we were having this conversation, we would really start the conversation about explaining how people are using technology to get healthcare. I don't think anybody needs that explanation anymore. So that definitely helped.
So talk to us about your outlook, because what Amwell does is basically provides the back end for virtual services that enable doctors to visit with their patients. What is your outlook for how much more this business will grow? As I understand it, telehealth, telemedicine sort of hit its peak in April and hasn't seen as much growth since then.
Yeah, I think that's a great question, because there's really different types of telehealth. I think we're just kind of turning the corner in everybody's understanding of what it would do. There is the kind of the usual type of telehealth that people are, I think, getting familiar with, which is telehealth for urgent care, where you're stuck at home, pandemic-wise and everything, is you definitely don't want to end up in an ER if you have an emerging issue. And people are using telehealth to quickly get in front of a clinician. That volume of telehealth has definitely peaked at the time that everybody was socially distancing. And as new alternatives are beginning to open up, we expect that to normalize. However, the bigger part of telehealth that we do is actually not in the area of urgent care, but rather powering clinicians to use telehealth with patients they already have a relationship with. These are chronic patients. These are patients with cancer. These are heart failure and diabetic patients, patients of hospitals that need to be seen again and again and again. That patient population has very quickly become the majority of telehealth that we do. And if anything, I can tell you that the lessons learned from the pandemic is everybody is saying, why didn't we think about this earlier? Because it is such a relief for everybody to do healthcare that way. That part is trending up and is never going back. It just opens up the door for a completely reimagination of how healthcare happens for the people who are most vulnerable.
Now, talk to us about the growth opportunities then that you see, because obviously, you know, you've got some consumers who've been doing this now for the very first time, and, you know, there are certainly, you know, potentially huge new avenues of growth in the road ahead.
Yeah, I think, you know, where do you start? The reality is that for people who are not very sick, for people who don't have any chronic condition, the word well, as we call them, most of us, telehealth stands to become a bigger and bigger place that you can go to when you have a new emerging healthcare needs, to the point that the use of telehealth for primary care, as we call it, is going to escalate in front of our eyes. There's so many people who don't have a PCP or people who can't get to a PCP, and telehealth can actually kind of grow into delivering more and more comfort in knowing that that is the first place that you go when you need healthcare. And that's going to be a big part of the growth. The second part of growth is really when we start thinking about where most healthcare dollars are going, which is to that patient population that requires very frequent care. To them, the name of the game is, can we help them using those technologies to stay at home longer, to get discharged from the hospital sooner, to get more of the different types of healthcare that they need to deal with their condition to come to them or surround them and be better coordinated. In every one of these elements, we have seen astounding realization during COVID that telehealth can do so much more than what everybody envisioned it could do even 6 months ago. Each and every one of these is a profound impact on how healthcare is being done, and really in the area that healthcare actually translates to the bigger part of the GDP, chronic patient, elder Americans, elder population. There's a sea of opportunity that we're just turning the corner to even realizing is right in front of us.
Google invested $100 million in Amwell, and Google obviously has its own health ambitions as well. Are there any opportunities to partner there?
Yeah, there's, you know, the matchmaking between us and Google, I think is kind of the gift that gives on giving, or whatever the term is. There is an understanding that for this technology to serve people, to make healthcare surround us where we want to be, it's not only getting connection between physicians and patients. It's a lot of other technologies like AI and machine learning and sensors in the home like Nest, if we kind of point out to Google technologies, that are going to do their part in making sure that healthcare surrounds you. It needs to be understandable. It needs to be intuitive. It doesn't have to be that painful as it used to be for so many generations. So blending together the elements that touch people directly, and Google is very good at this, with the ability to escalate an understanding that something is wrong with that person and we need to get healthcare, you know, in front of them, is really kind of the construct of bringing the two companies together. There's a lot of other avenues that we're exploring together. Google really has an astounding world of technologies that can be helpful. But this is the thinking, and it works really well.
Now, let's talk a little bit about profitability, because as you've been growing, your losses have been widening. What is the timeline to profitability? So
we've included the timeline, you know, in the S1 and continue to be very open about it, that this is still a work that will take a couple of years to get there. I think the realization is, and we've been very fortunate with the backing of American Well over the years, in understanding that it's not a steady state reality in terms of the opportunity that's coming up. We want to make sure that we have the resources in order to capitalize on the completely new dimensions of telehealth that are opening up. We've heard from CMS only recently, from the Center of Medicaid and Medicare, that they're going to begin to cover telehealth. We want to be ready for that capability, for that revenue opportunity as well. So we feel very bullish about our plan in terms of the transition to profitability, and it looks like from the behavior and from everybody that joined us today to become part of the company that it actually makes sense to everybody.
All right. Well, we'll definitely be tracking your progress. Roy Schoenberg, Amwell President and CEO. Thanks so much for joining us. Well, with the slew of new IPOs this week, what are the telltale signs these companies can indeed weather the pandemic? Well, Dana, Fidelity Contra Fund Manager, spoke exclusively with our own Eric Schatzker about investing in the post-pandemic era and how he has managed to beat the S&P 500 by an average of more than 3 percentage points every year for 3 decades.
I would say that I feel great about the companies I own in Contra Fund. They were well positioned and growing and extremely well managed before the pandemic. I think what's been really unbelievable and inspiring is how well so many public companies have managed through the pandemic. I mean, here we are having this Zoom interview, Eric. The technology that we live with has made this pandemic, relatively tolerable for many, many people and many, many companies. And I'm confident that the companies that I own are going to resume their growth and, continue to thrive after, a vaccine comes out and we can finally, slay this unnatural and frustrating beast that we're all fighting right now. So I feel good about that. But, certain companies have benefited more than others, and I always prefer to invest with companies that are doing well right now. So I would say the fund is heavier in, work from home, study from home beneficiaries than not. I have not, bet big in airlines or hotels at this moment, but they, as will benefit and do relatively well when the pandemic finally ends. I mean, Amazon has been, an unbelievable stock, but extremely well managed, a continued opportunity as e-commerce continues to gain market share. I mean, think about it this way, Eric, who wouldn't want unbelievable selection, great prices, and the convenience of having your purchases delivered literally in a day or two right to your very doorstep. So, if Amazon continues to execute, I'm sure that it'll be a good stock going forward. It's had a great run, and you make a very good point that many of the COVID beneficiaries have appreciated a lot in the last year, and we have to be careful and we have to be patient. But, if you say, would I rather own it for the next 10 years or not, I think it's clearly, a long-term buy.
There's more concentration now in stock indexes than ever before. Apple, Microsoft, and Amazon account for almost 30% of the Russell 1000 growth, for example. And what I'd like to know is this: is that a barrier to position size for you, or are you willing to concentrate the Contra Fund even more than the index if you like the stock enough?
We're in a funny time where the big companies seem to be very, very well positioned, and that presumably will accrue to their profits going forward. But as very large companies, it's harder to grow in, very, very rapidly over time. I mean, if you're a $2 trillion company like Apple, maybe you'll be able to grow 10 or 15% a year for the next 5 years, but you probably won't be able to grow 50% a year. That I think is a challenge for a bigger fund like mine, to be able to invest in enough very fast growing companies to make a difference.
Do you worry that some of those companies, Amazon, Facebook, Alphabet, are getting too big and might be targets for regulation or perhaps, even antitrust action if there's a Democrat in the White House?
Yeah, I agree with Jeff Bezos on this point, Eric, that big companies should be monitored, and that's a good thing. It's important to have governance and regulators making sure that big companies are doing the right things and operating, fairly. I worry that regulatory bodies and press concerns become a distraction to management. I want my company executives to be focused on their customers and trying to delight their customers. I don't want them distracted by having to speak with Congress people and respond to rumors and this sort of thing. So yes, I do worry about that.
Bloomberg's Eric Schatzker there speaking with Will Danoff, Fidelity Contra Fund Manager. Coming up, after overturning the auto and rocket launch industries, Elon Musk has his sights on satellites, why the Tesla founder hopes low Earth orbits will help him succeed, where so many others have failed. This is Bloomberg. Every few years, someone comes along promising to disrupt the satellite industry, burning through billions in cash before ambition crashes back down to Earth. Here comes Elon Musk with promises of filling the skies with thousands of satellites to internet and to bring the internet to isolated populations. For more, I want to bring in Ashley Vance of Bloomberg Businessweek, who's been reporting on Elon Musk and his ambitions for a very long time. Ashley, thank you so much for joining us. Talk to us about the progress that Musk has made on his satellite ambitions so far.
Yeah, well, I mean, in a lot of ways, the progress has been pretty dramatic. They've already put up SpaceX's internet system is called Starlink, and they've already put up about 700 satellites to power this thing. They're aiming to put up as many, as tens of thousands. And so in that sense, they've done well. That's more satellites than anyone's put up in history for one company. They still have to actually get the service up and running and prove that the antennas work back here on Earth and that they're cheap and affordable, and so all the hard stuff that goes with it.
Now, when you look up at the skies today, it's so much different than when we looked up at the skies at children, and you see multiple satellites, almost any time you gaze to the stars. I'm curious, is this all actually good for our environment, the space environment?
Yeah, I don't think people have quite really realized what's happening yet, which is that basically, space has gone up for sale. So I mentioned SpaceX has put up 700 satellites. Before that, there were about 1,300 satellites orbiting the Earth at any given time. So they've already put up this massive fraction. And so then we're talking about in the next few years going to 10 times that many satellites going around the Earth. And SpaceX is not the only company trying to do this. Amazon wants to build a space internet. There's lots of smaller companies trying to do this. And so it's dramatic. I mean, whether it's good or not, I mean, these satellites do come back down to Earth and they burn up in the atmosphere, but there's no question that the heavens as we know it are changing dramatically in the next few years. And I don't think many people have been paying attention to this.
So how well positioned is SpaceX to meet its goals compared to other companies? I mean, is Elon Musk, he's certainly delivered on grandiose plans when it comes to cars and when it comes to rocket launches. Is this another thing you believe he will accomplish, whether or not it's good for the environment?
Yeah, well, I mean, in a lot of ways, they're uniquely positioned to do this because SpaceX is making the satellites, and then Elon obviously has access to the rockets as well. And so at the moment, they're kind of running circles around anybody else who's trying to do this because SpaceX has been doing one or more launches a month pretty much all year. I mentioned Amazon wants to build a similar service Jeff Bezos' rocket company, Blue Origin, has yet to fly a commercial rocket successfully. If they do want to put up their satellites, they're probably going to have to go to SpaceX and ask for space on the rockets. And so, it's a question of how many rides Elon's willing to give them. Otherwise, these other companies are going to take a long time to catch up. The biggest question at the end, though, is whether this type of service makes money at all. And so, Elon might beat everyone to putting thousands of things up in the sky. And just like the other satellite programs you've mentioned that have failed in the past, this one may end up just being a money loser as well.
Well, I know you will be charting the progress. Ashley Vance of Bloomberg Business Weeks. Thanks, as always, Ashley, for taking the time to join us. For more, check out the latest edition of Bloomberg Business Week, out now. Still ahead, which tech CEOs have done a better job in handling their company's response to the pandemic? We're going to hear from Glassdoor, revealing a list of standout leadership, and the rankings may surprise you. This is Bloomberg. Company leadership has been especially challenged during the COVID-19 pandemic, with senior managers having to make very difficult decisions. Using employee feedback data, Glassdoor is revealing which tech CEOs have been the most outstanding leaders and what employees are looking for. For more, I want to bring in Andrew Chamberlain, chief economist at Glassdoor. Andrew, you've got 8 tech CEOs on the top 25 list, not some of the names you might expect. I understand Mark Zuckerberg made the list in top 10 in the UK, but isn't even on the top 25 in the United States. What are some of the standout trends here?
Well, this is the best of the best, the top 25. And the 3 things that all of these companies have in common, and these CEOs, was clear and transparent communication with employees about what is going on during a pandemic. Second, providing flexibility, work from home, giving workers the tools they need to keep doing their jobs. And third, policies that support health and safety of employees first. So not just allowing work from home, but also for any on-site people, making sure safety protocols are in place. And that is ultimately what these 8 tech CEOs really shined at when we looked at what employees said on Glassdoor.
Now, there are no women in the top tech CEOs and only 1 woman in the top 25 CEOs. Why is that?
Well, this is just the top 25, and it's true that there is only 1 woman on this list, but women are vastly underrepresented. Among the S&P 500 companies, women CEOs only make up about 7%. So it's not necessarily a reflection here of the gender balance. It's just, this is what bubbled up when employees talked about CEOs who got out ahead of the crisis and really did things that were pro-worker. There is more women representation popping up in companies all the time. We've seen one of the big U.S. banks, for example, appointing first woman CEO. And so we'll just have to wait and see. It's very likely that will improve in the coming years.
And I know that this list is based on employee feedback, but we know that women are often judged more harshly than men, especially in leadership positions. And I wonder if there's anything Glassdoor can do with its methodology to look below the surface and figure out why potentially women aren't getting on this list, or how women leaders are being judged compared to their male peers.
That's true. I've done a lot of research on female leadership using data from Glassdoor. We did a big study looking at who considers a CEO great, and did the gender really matter compared to other things, like whether they were mission-driven as leaders, or whether they were seen as empathetic and transparent. In that research, we found that the gender didn't matter as much. It's much more important that leaders sell what a company does as a social mission. That's far more important than personal characteristics. But in this case, what we really see is that these CEOs here, the ones at the very top of this tech list, with Zoom video communications and Eric Yuan, of course, like, not only did they have a great company response to the crisis, but they were seen as critical for helping other companies survive during the pandemic, being one of the main tools. Same with Box. Box is, and Aaron Levy have sort of been the pillar that's keeping the economy running when everyone's working from home.
Eric and Aaron have both been on the show in the last 6 months. I thought that Eric Yuan being so high on the list was interesting, given that Zoom has weathered so many controversies. And I thought there might be a lesson in there that employees are really happy with his leadership. We have about 30 seconds left. What's your thoughts on that?
So Eric was recognized as one of the top CEOs at Glassdoor in 2018, and partly employees say that it's not just generous health benefits and including mental health care, but Eric has been transparent in having frequent feedback and helping people see pride in the work that they're doing, connecting people during the pandemic.
Okay. All right. Well, interesting list. Appreciate you sharing it with us and your insights on the names that are on it. Andrew Chamberlain, Glassdoor chief economist, thanks so much for joining us. That does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. Bloomberg Daybreak Australia is next. This is Bloomberg.